The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. We're in our new format, so you'll see if you're watching, my co-host Pieter is with me again, and we're talking about how to choose the right investment. So we'll get into the topic now, but for those of you that didn't catch the previous episode, Pieter, do you want to introduce yourself to everybody?
Yeah, hello everyone. My name is Pieter Villiers. I am a veterinarian by trade, also now working in the financial industry, and I have a finance YouTube channel called Money Marks. And in the previous episode, we covered offshore investing, which I think is very much a highly requested topic, and we can talk about it for hours. But we tried to just break down the basics around what you should consider, how to do it, and what things you need to take into account. And in today's video, we're going to take it a step back and just talk about how to actually choose an investment, which I think that's where we all need to start.
Yeah, I mean, it's probably one of the questions that I would get the most is, what do I do now? I've got some money saved, and now what do I buy? And it's exciting, to get going and start the journey, and actually maybe not just for those that are starting out. Very often people will sell their business and now they're sitting on a lump sum and they've gone from being a business owner to an investor for the first time. Now they don't know what to do. They don't know how to choose. So I think it covers the age and wealth spectrum of this. And so if you're sitting there with a business you're about to sell and you're feeling embarrassed that maybe you should have all the answers, don't be embarrassed. Almost no one has got the answers and until they've listened to you and me, and then they'll have all the answers.
Yeah, sure.
So I feel it's a little bit like building a puzzle. So you can't just start building a puzzle until you know what the picture on the box looks like. And then for those of you that are like me that build puzzles by starting on the corners, that's the first thing I'll do. I want to look at the picture on the box, and then I want to find those corner pieces of the puzzle. Corner pieces of the puzzle to me are your mix of assets. What have you got in cash, bonds, property, shares, and then maybe what you should have in those. So that jargon is the asset allocation or your mix of assets. And I feel that's maybe the starting point. That you should be getting right before you do anything else.
Yeah. And it's like the building blocks, building a foundation. Let's say we want to build a house. It doesn't help you start with the roof because it's just going to collapse. Even with the walls, you need to dig a foundation. You need to lay down the cement, and you need to have a sturdy foundation in place for your investment vehicle. And in order to do that, you need to first understand, why am I building a house? What does it need to look like? Is it a beach house? Is it a double story? Is it just a little townhouse? So you need to first step back and say, why do I want to invest? What are my goals? Is it a short term, medium term, long term? What is the purpose that this investment will serve? And then from there onwards, you can dictate, okay, what is the right mix of asset classes that needs to kind of fill in that picture that can bring you to that goal that you need to achieve.
Yeah, and I think you're spot on with your timeframes as well. If you've got a short-term goal, and let's say you've got to buy a new car in the next 3 years. If your goal is 1 year or 3 years away, putting all of your money into the stock market, it might sound amazing because you've watched the stock market's growth for the last 3 years, and investments have doubled, and you think, well, that's easy, I'll just do that. The unfortunate thing is that's probably the next 3 years is when everything will halve, and so all of your savings goals are going to go out the window, and you're not buying anything because everything's gone down in value. So your timeframes will, to a large extent, dictate what you can buy. So to me, I mean, my personal view is, if I've got a goal that's 1 year away, all of the money in that goal will be in cash. It'll be in a money market instrument or a fixed deposit if you must, or something like that, a money market fund. I don't mind. The thing that's going to pay me the highest rate of interest with zero risk. It's not tax efficient. It's painful to earn interest and then have to pay a bit of tax on it. But at least when the time comes for me to pay that thing, I haven't lost money.
Yeah.
And maybe on the other end of the spectrum, if your goal is 7 years away, then I feel, your 7 year money and longer, you can actually expose the bulk of that investment to the stock market. There will be we've got to talk about risk tolerance now, because I think that's the other big factor. But your time horizon can determine on its own how much risk you take. I'm not sure. You can give your own view. Like, I don't know what your time horizon is for crypto. I think that feels to me like a casino.
Indefinite.
Yeah. You've really got to have a long time horizon and a lot of faith. And I'm not sure about faith in investing, but I think if you view stock markets as your riskiest investment class, then 5 to 7 years is a good period for something that's going to be 100% invested in.
Yeah.
I don't know how you feel. And then maybe the in-between is where you need to then have a mix of assets. So a goal that's 3 to 5 or 5 to 7 years away, the longer the time horizon, the more you can have in shares. But gee, you really want a balance. Like I think a balanced portfolio, if you look at a balanced unit trust, no coincidence that they're about 65% in shares to 75%, and then the balance is in cash and property companies and bonds, because that's a very good mix to kind of give you growth, beating inflation, but not so much growth that you lose out when stock markets go down.
So I think it's important to remember when we say equity outperforms cash and bonds, it means we're thinking long term. If we zoom out 10, 20, 30 years, over the long term, when the short term kind of fluctuations even out, then it will outperform. But if we know equity did the best this year, it doesn't mean it's going to be next year the same thing. Maybe bonds or cash becomes the top performer. It's not impossible. So it's all about managing risk. And if you know that if it's a short-term goal, you don't want to take risk, go with the conservative assets like maybe cash and a bit of bonds. But if you know, now I'm 25 years old, I'm investing for retirement in a tax-free savings account, goal means go 100% offshore equity if you want to, because you have time to wait out the market. Unless you need that money within 7 years, that is where you're going to get your best growth. But it doesn't mean every year it's going to look like that. It's just the whole thing about life. If you want more return, you need to take a bit more risk. And risk, we mean in that sense, volatility risk of going up and down in the short term.
Yeah, I think that it's such a important thing for investors to make peace with before they start. If you're going to invest in a pure stock market index, South Africa or global, doesn't matter, understand that in a great year, you might get a 35% return. And that will be phenomenal. And you should be really happy. And then what you need to know is most likely the next year it's going to go down, because that's how life works. Whatever happened in the last 12 months, almost the only guarantee is that won't happen in the next 12 months. And when you look at these charts of what was the best performing asset class last year and next year and the year after, it's almost never the same thing. It might be that you're lucky that equities perform incredibly well over a 2 or 3 year period and it becomes the number one performing asset type. But most of the time, what you'll see is that it's incredibly volatile. There will be years when stock markets are crashing, bond markets will be down, property markets will be down. Your best performing thing will be cash. And yes, that feels great. Understand the next year it's probably not cash. So you're absolutely right. I think it's probably a good point then just to start talking about tolerance, your psychological tolerance for risk. In the old days, you'd kind of fill out a questionnaire if you were dealing with an insurance broker, and they would say, do you go skydiving, bungee jumping, shark cage diving? Okay, then you're a high risk investor, which is garbage. So just understanding that my view is psychological tolerance for risk is hardwired into us as human beings. If you've got a phobia, let's say you're scared of heights or you're scared of snakes or spiders, it doesn't matter how much education you get, you're always going to be afraid of those things. And I feel, and I'm not saying if you're scared of spiders, you're going to be scared of stock markets. It's totally different. But I think it's a hardwired psychological response. So you can educate yourself, you can learn more about markets, but at the same time, if you see your investment portfolio down 30%, and you've got no tolerance for risk, you're going to have a major emotional reaction to it. And so knowing that before the time is really important. And so you can do things to manage your tolerance for risk somewhat. Getting the mix of assets is important. Maybe doing different boxes of money. Some people work on that. But if you know that you're going to panic and have a really bad emotional response when you see your investments go down 30%, you cannot put all of your stuff into shares. Even if your time horizon is 30 years away, you've got more money than you know what to do with, you're going to make a bad decision when markets go down. Usually what's going to happen is markets will go down and you're going to sell everything and put it in cash. And about 3 days after you do that, markets are going to go up again and start recovering those losses. That's what happens. So understanding your tolerance for risk for me is one of the most important things to do. And unfortunately, it's not something that someone can see just with a simple questionnaire.
Yeah, I think, and I'm glad the industry has evolved beyond the point of just looking at a arbitrary amount of questions and subjective answer to how I feel about the day. Because as I think like studies have shown, the way that you feel that specific day and the way the weather is affects your answers to the questionnaire. So I think the biggest risk for me with following that kind of binary approach is if you're a young investor and you do test conservative, it's maybe because you just don't understand maybe how investments work. And now if you are put in a very conservative investment portfolio for 40 years, there's a lot of growth that could be missed out. So I think education plays a big part in that conversation to have with someone. It's just to say, okay, we see you are very conservative, but that's your risk tolerance, but your risk capacity is very high. So we need to find some middle ground there. Maybe not go full out 100% risk, but maybe let's go to 70, 80%, just so you understand, because we need to kind of think about the opportunity cost as well. And finance is very much I think a behavioral thing, emotional thing. There's, in my mind, if you look at being successful, if we say I'm a successful investor, there's maybe 20% knowledge and technical knowledge, and then 80% is behavior, because we all think, I'll just buy when it's low and I'll sell when it's high. That's what we should do. And what we do is we do the opposite. We sell when it's low and we buy when it's high, because there's the market hype. And I think sometimes we are our own biggest enemies, because we get scared when the markets drop and we want to fight or flight and take our money out, put it in cash. And that's the worst thing you can do. So to try and, I guess, mitigate most of that, having a proper discussion on risk and making sure you're comfortable with that. Also take into account what the risk you should take, and then automate the process. Let those debit orders go off, and don't log into your account every day. It's going to drive you insane, especially if you've been investing through COVID. It was a very crazy time. So automating the process, I think, takes a lot of that risk that we pose upon ourselves out of the equation, because we just rand or dollar cost average into the market every month.
Yeah, and I think if you know that you've got a low tolerance for risk, but you are young and financially you can afford to take risk, then maybe breaking your money up a little bit makes sense. In other words, you say to yourself, okay, I've got a big emergency fund, which is maybe bigger than ideal, but that'll get me through a year's worth of disasters. I've covered a year's worth of expenses. That sits in my money market account. I'm going to complain every year that I'm paying SARS too much in tax on my interest, but managing my emotions now becomes a bit easier, because what you've done is you've built in a shock absorber into your financial position. And then maybe you take a portion and you put that in, that's invested very conservatively in, like maybe a higher exposure to government bonds and let's say, it's wrong to say property companies are conservative. They've proved to be very volatile, but stuff that moves very differently to the stock market. And then you can take a portion of money, invest in global markets and the local stock market, and that you don't pay attention to, because what you've done is you've covered any emergency for the next year. Then you've got a cautious, conservative portfolio that will look after you for the next 3 or 4 years. And so your 5 to 15 year money, you just don't pay attention to. Obviously, you've got to make sure it's the right portfolio. I'm not saying, go buy 5 individual shares and never look at them again. That's not risk management. But I think for people who are very conservative, that might be the answer once you've gone through the education process. I think I've noticed, portfolio managers and hedge fund managers, that when you talk to them and their spouses about their own money, you realize that professionally they can take risk in a particular way because it's their job. But the moment they invest for themselves and their families, they have a totally different risk tolerance. So I do think education is important to a point, but that psychological thing, for some people, they can't get over it. They can't manage that. In which case, create the right portfolio that suits you, but doesn't. I agree with that point. I think it's a tragic outcome if you're 25 and you've decided you're conservative and then you put all your money in cash for the next 30 years. You're not going to beat inflation. So you've got to find ways to do better. Yeah,
it's all about just a balanced approach. It's going back to the financial goals, making sure you've got your short-term goals checked, your emergency fund, so that you don't have to go into your long-term investments to cash them out for a short-term emergency and being forced in that to play that hand. The medium-term goals, the car deposits, the house deposits, having that in a cautious fund, and then the retirement ones. Some, with retirement annuity, that's kind of limited in any case. But it's all about balance and just making sure that each investment that you have serves a specific purpose, and you are just putting money somewhere just for the sake of it. It has to have why are we investing? What is the time horizon? How do I feel about risk? And combining all of those factors, what is the best kind of asset allocation to meet those goals? Because I think there's also a risk in us not meeting our goals, as there is a risk of the markets going up and down, and the risk that there's taxes and fees and all of that. The risk of us not reaching our financial goals is also something to take into account. So that is why it becomes a bit more of a dynamic conversation when we say we're going to invest money. It's not as easy as just buying Apple shares. There's a lot of stuff that you need to think about.
Yeah, if it was easy, everyone would do it, right?
Yeah.
And everyone would succeed. I mean, I think your point around the person in the mirror is the thing here. Like the reason that high salary earners, 5 out of 100 manage to get to financial freedom. Why? 95 out of 100. The problem is not the markets. It's nothing else. It's the person in the mirror. It's actually, we don't make the right decisions for ourselves at the right times. And so, I mean, I love that point around understanding why you're doing this. Because equally, every month, no one starts the month with enough money to do everything they want to do. And so you're going to be faced with trade-offs. You're going to get to the point where you're going to say, do I want to buy that third coffee every single day from the barista because I think that barista's hot or they make great coffee, whatever the deal is? That's fine if that's what's really important to you.
Yeah.
Then you're trading off something else. But if you're just buying the coffee because everyone else is doing it, don't be mindless. You've got to be clear in terms of this is why I do something. And we're not saying don't have fun. We're saying be intentional about the money you allocate to the fun, to the luxury, and then to the savings. What that allows you to do, if it's clear in your mind about the why you're doing this, it allows you to make those decisions, which are hard. It's hard to trade off. It's hard not to just do whatever you want to do. You can only do that if you're clear about why. So I love that point. I think it's probably, we should start every show by saying, why are you doing this? Do you know why? If you don't, go and look in the mirror, go spend some time, write it down, be clear.
Yeah, and that's the thing. I found that keeping with a plan is only possible if you enjoy the journey, because it's never really about the destination. Like we always think about, but I'm planning for retirement, but what is that? Is that 65? Retired? What now? So and then oftentimes if we get so fixated just on the destination, we don't physically enjoy the journey. The plan doesn't work, because now we may decide, okay, we're going to try and invest everything and cut down on all our fun stuff. Probably going to be able to do that for a couple of months, and then the plan will collapse and you'll go back to your old habits. So it's all about balance. It's about, if you're young and you start with a little bit, that's okay, because you've got time to compound. You need to decide what's important to you and spend money on that, but you also need to make provision for your short, medium, long-term goals. It's all about that kind of lifestyle that you want to live now and in the future, and balancing that out, which is tough.
So, I mean, I'm married to the spreadsheet queen. And so what we'll do at the start of every year is we'll say, okay, so this is how much of our money we need to allocate to our long-term savings. If we're doing that, so if it's a debit order, because I love that, automate your savings. If we're doing that, that means the next bit of money we can allocate to the thing which is exciting for me, which is the holiday fund. And now I can go on holiday guilt-free because I've allocated my money to my savings. And for me, because I don't buy new cars, but I'm always going to buy a replacement, let's say not a new car, a replacement car every X years, then that I'll allocate some money to that. And my wife will spend like double the number of years in her car, and she'll be happy with that. So doing that, as you say, to your lifestyle and your needs, if you allocate the money correctly and you know why you're doing everything, life becomes easier. So I think it's a PowerPoint.
Yeah, it should be fun. The whole point of investing is because you're trying to build a life for you and your family in the future, whilst also living today and balancing those two. And I think for me, at least from my own experience, when I started learning about money and investing when I was still a vet, it's a little bit daunting in the beginning, because there's so many terms that you're like, gee, what does this mean? But the more you learn, the more you enjoy it, and the more you get involved into the process, you're essentially building your own life. And that is what money can bring you. It's a tool we use to live the best life we can with those we most care about. So as long as we start having that healthy relationship with money, then I think it also helps with the investment side, so that we understand why, again, going back to, we're taking this risk because we want to retire early one day. So hence why we need to stomach the short-term volatility when it comes, and it will come.
I think that's the perfect note to end.
Awesome.
I'm Warren. He's Pieter from
Money Marks.
Money Marks. Thanks so much for joining us.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.